Buying a stock is easy. Buying the right stock, however, is not such a walk in the park. Stocks can be difficult things to predict, and they tend to have a knack for going the exact opposite way you want them to go. With so many names on the market, it gets so hard to choose the perfect stock. Even finding one to put on your watch list becomes such a Herculean task in the face of the ever-shifting investing climate. It is important to choose the best stock with potential for large growth in the future. There are hundreds, if not thousands, of stocks trading on the NYSE and NASDAQ. You would want to find the very best stocks right now to generate massive future gains. A large number of companies have now released their quarterly results, and the economic recovery has accelerated. Many companies have reported huge increases in sales, and now investors' attention has shifted from summer trends to the fall season. In this video, we're going to break down 5 of the hottest stocks to purchase right now and predict their chances of gaining in the future. We believe you would definitely want to add these to your investment portfolio. Ever since the bear market of the coronavirus pandemic, stocks have been rebounding powerfully. This action reflects the apparent rise in confidence that the economy has experienced. It is proof that the economy would eventually recover from the devastating effects of the coronavirus. The virus still remains a concern even as the number of cases tumble. Vaccination numbers have seen a rise among Americans, but the rising number of cases of the Delta variant is becoming a source of concern. Major indexes have revealed the strength of the economy is bouncing back strongly from the recent challenges. The stock market was given an additional boost by Federal Reserve Chairman Jerome Powell. He has affirmed the central bank's plan to scale back its stimulus policies. This is good news for inflation, as it is expected to recede in the coming months. Which stocks are predicted to see the most growth? Let's find out. Number 1. Microsoft. Several high-profile companies like Apple have pushed back the date on when their employees return to the office due to the high corona figures in the U.S. The lack of their physical presence in the office is good news for cloud companies like Microsoft's Azure and Office 365. Microsoft's work-from-home trend continues to dominate the corporate atmosphere, and they continue to close major deals on both enterprise and consumer packages of its cloud services. These kind of deals are expected to bring the company significant revenue in 2022. Many say Microsoft is poised to gain more market share than the Goliath, Amazon Web Services. This projection has spurred the company to raise its prices for Office 365, which could bring in more than $5 billion in revenue by 2022. That's a whole lot. We believe its stock will climb higher towards the tail end of the year. At Microsoft, the dividend yield is at 74 cents per share. Number 2. Applied Materials. The increased demand for smartphones, computers, and cars, as well as the rise of closed-chip factories, have created the perfect storm for investors. The ongoing shortage of semiconductors have put pressure on the technology makers for much of the second quarter of the year. Several analysts predicted the deficit would become narrow, but the situation is as simple as that. The increased demand for technology is good for the company, as it expects revenue to continue growing well beyond 2022. We believe this stock is one of the few that will outperform its peers in the 2022 market thanks to the numerous opportunities offered to it. In the latest report, Applied Materials had better than expected results for the second quarter. This has raised expectations for the third quarter, as they now have an order book of more than $10 billion. This fact makes it clear that the potential of the company and the heights it can attain in the near future. At Applied Materials, the dividend yield is 7%. Number 3. Target. The market for consumer durables has been booming over the past year. Even in the online sector, the growth has been exponential. Target has done a good job of withstanding the tests on its capability. It continues to increase its presence online and with its physical stores. The company has arranged its logistics so well that the increasing demand was absorbed without so much as a sweat. The increased shipping costs may play a part in putting a dent on their profit margins. The company has just recently approved $15 billion in new share purchases, which is good news for potential investors. Target has recently reported a 7% more increase in earnings than what the analysts on Wall Street had predicted. At Target, the dividend yield is 1.44%. Number 4. NVIDIA. Yet another semiconductor giant is facing an increased demand for its chips. NVIDIA closed its second quarter well, and it is predicted to continue to bring in revenue as gaming and automakers are crazy over the products. NVIDIA beat Wall Street's consensus estimates for the second quarter in earnings per share and gross margins. As margins expand, significant operating leverage is expected. Their acquisition of the technology company ARM Limited doesn't sound like it would be completed soon. The hurdles have continued to pile up and the negotiations drag on. The demand for data centers continue to increase as the trend of enterprise cloud computing continues. Data center construction remains NVIDIA's biggest growth engine, but Jill also sees a growth opportunity for NVIDIA's Triton programming language, which allows an internet service provider to run an entire data center. In addition, the volatility in cryptocurrency mining regulations is not seen as an issue. Although NVIDIA's graphics chips are popular among miners, the revenues from them for the company are not significant. At NVIDIA, the dividend yield is 0.7%. Number 5. PETCO. Being able to spot trends is one of the most important requirements for Wall Street's top analysts, and that certainly applies to PETCO. The corona pandemic kept people at home, and many subsequently bought a pet. Robert W. Baird's Peter Benedict wrote that PETCO provides a unique, fully integrated pet care ecosystem to the U.S. pet market, worth some $100 billion. Strong Q2 earnings, roadmap to providing veterinary services, and reduced debt make it an attractive stock. Pets are a regular expense and require different services to care for them, so customers come back often. PETCO is conquering this market with its diversified offerings and has also expanded its own veterinary services, a long-term initiative that will increase market share. The company posted good results for the second quarter, beating consensus and raising expectations. Pet stores immediately regained popularity when the economy reopened, and premium services such as grooming, training, and medical care are in high demand. Partly in the view of the company's additional initiatives in merchandising, services, digital, and data analysis capabilities, PETCO's share is attractively valued. These are some of the stocks we predict will see a certain rise in the future. Are there any stocks you think we missed out on? Let us know in the comments section below, and we would be sure to tell you what we think of the stock. If you enjoyed this video, remember to like and subscribe if you haven't already. Feel free to join our financial community by turning on your post notifications in order not to miss out on any of our new videos. If you want more advice on stocks, be sure to check out the videos currently on our channel. Bye for now.